But you can see that as soon as the market understands that the dollar as the reserve currency is toast. I mean, I know that if you look at the statistics, you see that, 85% of global trade is all done in dollars and so on and so forth. Yeah. But that's history. What we're now seeing is something which is a very definite challenge to that domination of the dollar over global affairs.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for June 27th through July 4th, 2023, while supplies last. This week we feature Asahi Silver Rounds at $3.49 over spot, 2023 1-ounce silver maple coins at $4.25 over spot, and backdated 1-ounce silver Australian kangaroos at just $3.89 over spot. First, the Asahi refinery continues the legacy of famed private mint Johnson Matthey, which they purchased in 2015, and refined with the same attention to detail, cementing their status as an LBMA certified supplier. Their 1-ounce rounds are 3/9 fine and on sale for just $3.49 over spot. Next, silver maples were the first silver sovereign coins to be minted at 4/9 fine purity, and the 2023 silver maples remain one of the most in-demand coins today. They come 25 to a tube, 500 to a box, and are available at $4.25 over spot. Next, backdated kangaroos are 4/9 fine 1-ounce silver sovereign coins of Australia. They are renowned for their purity and design. They come 25 to a tube, and with just 250 coins to a monster box, they are the most affordable monster box available, especially at just $3.89 over spot per ounce while supplies last. Our specials this week are all IRA eligible, and if you'd like to learn more about a precious metals IRA, call us, and we'll be happy to help you in that process. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always privileged to have this distinguished returning guest. Alasdair Macleod is the head of research at GoldMoney.com. He's also a former bank director, and he joins us this Wednesday, June 28th, 2023 on Liberty and Finance. Alasdair, as always, thanks for coming back on.
That's my pleasure, DK.
Your experience as a bank director and your years of research into the financial and monetary systems gives you a lot of credence that our viewers are eager to take advantage of when hearing your perspectives and your analyses of what's going on in our financial world. Most recently, you've done some additional research into the phenomenon of gold weakness in the face of all this financial mismanagement that's been going on and what that might signify. But first, could we touch on a topic that's been in the news currently, and that's whether there'll be a reignition of conflict in the Ukraine. And we've certainly seen that sparked a lot of activity in the metals, interest in the metals, concern about financial stability in the region, etc. What are you watching there from your perspective in the UK?
Well, it's an interesting question because this is just being recorded, I think, about 2 or 3 days after the Wagner rebellion, if I can call it that. And the thing that's fascinating about that is that it does appear that there's some sort of intelligence role from either the British or the Americans or both, because according to today's Daily Telegraph, which is directly fed really by the intelligence services, this rebellion, revolt, whatever you like to call it, has been known in great detail for some time. This is literally a quote from this morning's Telegraph. So how do they know? Why do they know? I mean, it raises the question as to whether this was actually just something that was put up by our intelligence services trying to undermine the unity between the shock troops, if I can call them that, of the Wagner lot and the Russian army. So that has now been put to bed. And I mean, we don't know for certain. I think it's quite likely that the defense ministry in Moscow took the view that they have now finished using the Wagner troops, division, whatever you like to call it, and therefore the mercenaries' contract has effectively come to an end on that particular activity. Now, of course, Wagner does have other activities for Russia, particularly in the Middle East and also in Africa. They're known to be active in the Sudan, Central African Republic, Chad, possibly even Mali. And really, I think their role has now become one of countering if you like, the black ops operations run by our intelligence services in those areas. So that continues. And I think that as I understand it, most of the people who have been selected out of the Wagner group have now been moved into the army. Now, what I would expect is that now that the Ukraine's push in the south and east of Ukraine to try and recover territory around Donetsk and so on has effectively got nowhere. I think that Putin sees it now as his turn to have a push. And bear in mind that Kiev is literally only 60 miles from the Belarusian border, where the Wagner troops have been diverted. I don't know what the strength is of the Russian army there, but there certainly is a reasonable presence there. And I would expect to see a thrust from there and an attempt to capture Kiev. I think this is desperately important because, the reason I think this is likely to happen in particular is if you look at what's been happening to the ruble on the foreign exchanges, what's been happening to bond yields, Russian bond yields, and if you look at also at the way in which the balance of payments surplus has been coming down, it's come down really quite dramatically. You can see that unless Putin acts fairly soon, he could come under pressure, if you like, as far as his currency, as far as interest rates, and obviously as far as the sort of the overall economy is concerned. Now, in order to restore the position, he needs to take an action which will drive up commodity prices to something which gives the Russian economy a decent surplus on its balance of payments. And of course, this would fit in very nicely with a counterattack after the failed Ukrainian attempt to drive the Russians back. And that counterattack, I believe, will happen in Kiev. In terms of timing, I think it could happen quite quickly for two reasons. Firstly, the Ukrainian forces are about 400 miles away, and it will take time for them to be regrouped, if you like, to protect Kiev. That's the first thing. The second thing is that we have on August the 22nd to the 24th the new BRICS summit in Johannesburg in South Africa. And I suspect that there will be developments there which will tend to undermine Western currencies. Now, I'm specifically referring to what I would suggest is only outline proposals, maybe not even that, but a statement of intent about BRICS producing a new trade settlement currency. To remind everybody, a trade settlement currency is currently proposed by the Eurasian Economic Union, and this is being put together by Sergei Glaziev, who is a very close confidant of Putin and economic advisor. And he has moved from the original brief of looking at something which is comprised of the participating nations' currencies and the commodities, which presumably will be weighted in some way to reflect the trade between the EU membership. Now, that was obviously not going to happen. And we had last December an article written by Sergei Glaziev in a Russian business magazine called Vedomosti, where he quite clearly laid out that the answer to all this is gold. And he was more specifically talking in this sense of the ruble going on to a new gold standard. But clearly, given that it was also co-written by one of his committee members from the EAEU, this is something which I think is his current thinking on that project. Now, I would expect that project to be expanded to encompass not just the EAEU, which might have run into political difficulties because of the small number of the Central Asian states that are part of the EAEU, into a wider membership. And I think this would encompass the Shanghai Cooperation Organization and also BRICS. And BRICS is expanding. There are a number of countries which have actually filed for membership. There are a whole host of other countries that have expressed interest, either in membership or interest in, some sort of association with BRICS. Now, if you look at these, we're looking at, the two things that stand out. One is that the GDP, combined GDP of all these countries, is roughly a third of global GDP. This is not a minor thing. This is really very serious, and it encompasses roughly 64% of the global population. So this is really quite major. There are, including France, which I think we ought to knock out of this. Actually, there's something like 31 countries which want to join BRICS or have expressed an interest in joining BRICS. This is quite something. So now, why does this matter? Well, I think as soon as it becomes obvious that there is a new currency which is definitely being planned, and it would have to be around gold. I mean, that's the only thing that works. The market might sort of have a little bit of a think about this and conclude that this is actually pretty bad news for the dollar. And that's the key thing, because it's the dollar's hegemony which is being challenged by this. They are seeking to replace a currency which is the monopoly of one country with a new currency which does not have monopoly ownership, and which can, under the umbrella of which free trade can develop amongst this 33% of the world's GDP. This is potentially a very, very big deal. Now, it's not going to happen overnight, but you can see that as soon as the market understands that the dollar as the reserve currency is toast. I mean, I know that if you look at the statistics, you see that, 85% of global trade is all done in dollars and so on and so forth. Yeah. But that's history. What we're now seeing is something which is a very definite challenge to that domination of the dollar over global affairs. So what I see really, and you touched on the subject of gold just a little earlier, what I see really is two things. I think the first thing is that when Putin has a crack at Ukraine, we don't know how it'll turn out, but I think he's probably a bit better organized this time than he was when he first had a crack at Kiev. If you remember, the forces came down from Belarus and they got really within the suburbs of Kiev before they were driven back. I think this time it's likely to be somewhat different. He's got, I think, a sensible plan, or at least I've got a sensible plan, which he might follow. That's probably a better description of it. But I think this is very, very likely. That is the first thing that will drive up the price of oil, the price of other commodities, in anticipation of nothing else for the West's, attempt to, sort of impose even greater sanctions or whatever it might be. I mean, we're looking at a war situation where Ukraine is just the proxy. An acceleration of this situation is not going to be without its dangers. So that's the first thing. And the second thing is that once it becomes clear that there is going to be an alternative, a viable alternative trade currency to the dollar, then I think that's going to undermine the dollar further. So we have an interesting situation. And the other thing I would say about people who might be concerned about the declining gold price at the moment, is that the reason cited is that interest rates are not going to come down soon. You've got you've got people sort of seeing the U.S. economy is not really going into recession. If you look at the unemployment numbers and so on, look at the statistics which the Fed looks at, and where's the recession? It's not in sight, sort of thing. Now, all this is a bit will-o'-the-wisp type stuff, but you can see why the traders in the paper markets would take the view, because they're all Keynesian, they would take the view that if interest rates are going to remain higher for longer, then that works against gold. Conveniently forgetting that in the 1970s, we started the decade with gold at $35 and the Fed funds rate at about 6.5%, something like that. We ended the decade with gold at $850 and the Fed funds rate at 19-20%. So, this idea that high interest rates is bad for gold is not the case. It only becomes the case if interest rates are raised sufficiently to really persuade funds to move out of protection mode back into credit currencies. In other words, a Volcker type move. Now, if you're going to consider that as a solution, then I think you rather need to have your head examined, because that would collapse everything. I mean, it really would. As it is, even a small rise in interest rates from the current level implies enormous risks for the banking system. It implies enormous risks for property markets. In the United States, they're talking about commercial property lending. In the UK, I mean, everybody's up in arms because of the cost of mortgages. I mean, people have come off fixed rates and found that, their monthly payments have gone from something like £600 to £2,000, and this is a huge impact on any family budget. So high interest rates aren't going to be fun, and I think they could potentially be destabilizing. But what will drive it particularly, I think, is not so much the economic outlook, but a mixture of the contraction of credit and increased risk from the Ukraine situation, which I think is about to take off again, with in time, and we're not talking a very long time, it's 6 weeks or so, before we have the Johannesburg summit for BRICS, which I think could have a major impact on how we view things currency-wise.
You've spoken with us in the past several times about fragility in the banking system, not only in the U.S., Japan, elsewhere all over the Mediterranean, etc. And just now you mentioned the 1970s, when we had this rising interest rate regime that was really a difficult time for the economy that entire decade. Is this high interest rate, which you've described to us as a very difficult thing, it could be toxic for banks if it drives down the value of their bond portfolio, et cetera. Is that a transition that they need to get through, or is it really likely to be cause bank failures in increasing numbers because banks simply can't ride that out? Once their bond portfolios are marked down, then are they stable again, or is it just that's too much for them to survive?
Well, how can I describe it? It's a situation really over which nobody has any control. I think forget about inflation. Well, not completely, but put that to one side. What we're now seeing is contracting credit. Why are we seeing contracting credit? Because banks' balance sheets are over leveraged. The relationship between assets and shareholder funds are pretty much at all-time highs. And this is something which basically means that any loss on the balance sheet is magnified by that ratio on the shareholders. So bank directors are now very aware of this. So we've transitioned from a time when bank directors were sort of quite happy about the future. So business as per normal. The reason that a bank has increased its balance sheet leverage is because with zero interest rates, or in the case of Japan and the Eurozone, negative interest rates, margins become horribly compressed. So how do you maintain your profits? Well, the answer is you increase your leverage, and that's what they were doing. But we're now in a situation where any bank director who doesn't actually think, hold on a minute, we've got escalating risks, they should be sacked, basically, because that's the situation. And not only is that the situation, but you've got a cohort of bankers all thinking the same way. They're bound to think the same way. They see increased non-performing loans, as they politely put it. In other words, borrowers going bust, and they don't want to impose their losses. It's not their function to expose their shareholders to those risks. So they're going to try and contract their balance sheets. They're going to try and not lend. And it means that, if you're a businessman and you have, say, an overdraft facility at your friendly bank of $1 million, you go in to get it renewed. The banker says, well, I'm sorry, we can't give you the $1 million. We could probably do $500,000, but it is going to require more collateral, and it's going to require a higher interest rate. So you can see what's happening. It is what I'm describing is a credit crunch, and it's that is going to drive up interest rates from here. I don't care so much about the inflation prospects. I mean, that is obviously something which is desperately important, but in this context, it's really all about a credit squeeze. And when you get rising interest rates, of course, you get falling bond prices, rising bond yields, as it were. You get falling asset prices, all financial assets. You also get falling property prices. So you can see that we're locked into a cycle which is entirely predictive. This is the way the banking cycle has worked ever since. I mean, we've got records going back to just after the Napoleonic Wars. It's what happens. And this is why the Austrian economists, are so anti what they call fractional reserve banking, but actually it's credit creation by the banks, because they see these crises. It drives the business cycle. The reason that you get this sort of cycle of ups and downs, boom and bust, however you like to describe it, is because of the behavior of the banking cohort. We are about to tip into the nasty side of that cycle. And it will involve a credit crunch. It will involve banks trying desperately to contain the risks on their balance sheets. And if you throw in the geopolitical problems, which I've just described, on top, you can see that it just exacerbates that situation entirely. So that, I think, is roughly where we are.
It's clear to most people that high interest rates mean that their asset prices, whether that's stocks that they may be holding or whether it's real estate, the prices what homes can sell for, that sort of thing, is immediately dampened by a high interest rate environment. What's not clear to most people is how that hurts banks and whether that puts them at additional risks of their deposits that they have in banks. Can you touch on that just so that the ordinary person can understand the relationship there, that's the reality they're facing going ahead?
Well, there are two aspects of this. One was exposed with the Silicon Valley Bank, who accumulated a portfolio of, risk-free bonds, as they call them, U.S. Treasuries on balance sheet. And it believed that zero interest rates were going to be there forever, and a lot of people did. I mean, they weren't alone in this. So you can see that, the Silicon Valley Bank bit of financing the purchase of term bonds. And the way it worked at the time was they could borrow from the Fed at, say, 0.25%, and they could go out along the yield curve, which was positive, as it should be in any usual circumstances, and they would pick up a yield of, say, 1.5% by going out 10, 12, 15 years. And that form of financing actually sort of supported the whole situation to a great extent. But of course, since the Fed has had to raise interest rates, you can see that on the profit and loss account, suddenly they've got huge great losses because they're getting a coupon, say, of 0.75% or 1% on their bond investment. And the cost of funding it has gone from 0.25 up to 5%. So they've got an immediate loss on that. And because the yield on the bond has risen, they've also got mark-to-market losses, huge mark-to-market losses on the other side. So that's one side of it. The other side of it was best described by an economist in the 1920s called Irving Fisher. And no, it was 1930s, sorry. And what he was doing was he was analyzing why it was that you had collapsing financial asset values in the early 1930s when the banking system started imploding. And the answer was quite simple. Falling asset prices means that the value of the collateral held against customer loans goes down. And what the banks are forced to do is they turn around to the customer and say, look, your loan is no longer covered. What are you going to do about it? Customer says, I can't do anything about it. So bank sells the loan. And so what you had was this cascade of self-feeding, falls generating further sales, and so on and so forth. It's those two factors which really do undermine the whole system. And this is, we're pretty much on the brink of this possibly happening yet again. And I think that higher interest rates, if the Fed and other central banks continue to raise interest rates, which they are bound to do because, they no longer control it. It's now in the hands of bankers who are just running scared of lending. It's that credit crunch I was talking about. It means that rates are going to go up. Now, the Fed and the ECB and the Bank of Japan might sort of say, well, we're not going to raise interest rates with this lot. But you've then got a problem. How is the government going to fund its deficit? Because that has got to be funded by institutions actually going in and buying government debt. Now, whether the Fed also goes in and buys government debt or whatever, that's QE. It's possible that might come back. That's not the current situation. So there would have to be a U-turn on that one. But you can see that from a situation which we've become very, very used to, from really the 1980s onwards, this business where government bond auctions are always successful. Why? Because you've got insurance companies, you've got pension funds who know the long-term trend in interest rates and inflation is down. So they're quite happy to participate in one of those auctions, knowing that, well, if it goes wrong, say, over the next month or two or quarter or whatever, it won't matter because if we just hold it, the values will be maintained. And also the other thing is that they know that with a generally falling interest rate environment, if they're going to lock in yields, they need to continue to invest in that falling yield market. So, but that's not changed. That's not happening anymore. And what we will find that insurance companies and pension funds and banks, if you like, if they're looking at trying to do something with their liquidity, their balance sheet liquidity, they will stand back. They will not participate in the auctions. The auctions will start going wrong. And then what happens is you've got unfunded government needing to jack up the yields in the market in order to get their stock away. And this, I remember this in the 1970s in the UK, in the middle of the 1970s. Believe it or not, we issued 3 gilts being government bonds, UK government bonds, with coupons of 15% and above. Now, just imagine that today. That is, what's that going to do to US government finances? It's just going to tear the heart out of, budget deficits, budget assumptions. It's going to, that is very, very bad news. But it is an increasing risk. And this is a risk which will be highlighted, I think, by the credit crunch. There comes a point, initially, one of the things in the credit crunch is that, a bank might say, rather than, we can't necessarily reduce our balance sheet, because you've got depositors. You can't actually destroy deposits except by going bust. They can be transferred to someone else. But if you look at the system as a whole, you can't really destroy the deposits. But the other side of your balance sheet can be destroyed by non-performing loans. So what do? You try and get out of the non-performing loans. You've then got liquidity, which you will put into short-term US Treasury bills, maybe US Treasury debt, bills and bonds, that sort of thing. And that it's when you go out along the yield curve at all that this is something they don't want the risk in a changed interest rate environment, in a credit crunch. So what they'll be doing is looking for cash and cash alternatives, in effect, on the asset side of their balance sheet. It's going to be, I think this is I can't really see how this situation can be avoided. I am looking ahead a little bit, but you can see that if the Ukraine situation starts to blow up again, as I've just suggested, then I think it's very likely that these problems are going to visit us sooner rather than later.
Well, that's been something that's been of grave concern for savers, earners, retirees, etc. in the U.S. for sure, and probably all over Europe and maybe the rest of the Western world, is this idea that their nest egg is no longer a sure thing. The nest egg, whether it's in government bonds or in bank deposits, is not a sure thing. And that's something that a lot of people, besides the fact of bank failures, which were happening in a bit of a flurry there for about a month, and now we've seen a holding pattern where that hasn't been happening at that same rate. People are wondering if they should wipe their brow and saying, okay, we're past the worst of it now. But what we're hearing from you and from others is that these fundamental dynamics that are at play show no signs of letting up, and the pressure is going to remain on those institutions, and that there's as much concern, or perhaps more than ever, of further risk going forward into the second half of the year. Any further last thoughts from you, and where people can find your work as well?
Yes. I think what you say is absolutely right. It is a huge concern. Normally, I would say that it is the function of a central bank to ensure that no commercial bank, defaults on depositors' obligations, or their obligations to depositors. That is necessary for the integrity of the whole system. But we do have a problem that is, and this was something which interestingly was admitted in Germany, that the Bundesbank, because it has been buying bonds which have gone down in value at the behest of the ECB, they've now got a book loss of over €1 billion. Surprise, surprise. This is something I've been drawing people's attention to. It's all very well looking at the commercial banks, but actually the central banks themselves are, by any description, bust. No, people don't worry about it because they say, well, they can always print their way out of trouble. To a degree, yes, that's right. It's not quite the right description of how you refinance a central bank, but what we're looking at is insolvent central banks trying to rescue insolvent commercial banks. And you've got the further complication that they changed the law in the wake of the Lehman crisis to try and protect the taxpayer. This was the meme, and the idea of protecting the taxpayer was when a bank goes bust, then the people who have got to pay for it are the shareholders and the bondholders. So that you had bailouts replaced by bail-ins. Now every G20 country has introduced legislation for bail-ins. Now they'd be stupid to do it. Really stupid to do it. They tried to do it with Credit Suisse, and there's a hell of a row about that. But the idea that you're going to get everybody in the central banking community really understanding that they shouldn't go the bail-in route, there's a risk that they might not have bought the message. There are genuine risks out there, and I think that. But the only thing you can do in some countries, this is not available in America, but if the government owns a bank from the last crisis, then have your account there because that will be supported. I suspect in America that the large banks will probably be supported, but there again, when you look at the JP Morgans and the Citis and the Bank of Americas and all the rest of it, you've got a further problem, and that is huge quantities of over-the-counter derivatives, which, if you get failing counterparties, I mean, how on earth you sort out that mess? It's a wing and a prayer if you're a depositor. I mean, it really is. But this is the whole reason why you should have gold or consider gold, because what you're doing is you're not buying gold. You are escaping from a failing credit system. That is the key to understanding why anyone should hold physical gold, either in bullion or coin firm. You very kindly asked me to say where viewers could find my research. Go to goldmoney.com and hit the research tab, and I write an article every Thursday. This is a Wednesday, 27th, 28th, I think. 28th. So one will be coming out tomorrow, and that will be about the Russian situation. It will be about BRICS. It will be about the new currencies which are being considered, and what the evidence appears to be as to what sort of form they will take. And that'll come out tomorrow, sort of, I suppose, midday EST. So that's about it. Well, the other thing, I do a market report on the Friday, which may be of interest to your viewers.
All of that can be found at goldmoney.com /
research. Yeah.
Excellent. Alasdair Macleod, thank you always for joining us here on Liberty and Finance.
That's my pleasure, DK.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.